Welcome to my channel. I'm going to show you step by step how to value a stock so we can determine whether it's a buy or a sell. At the end of the video, we're going to look at the financial ratios of the company. Leave a comment and I'll be sure to answer. We're going to look at Wimpey, which is one of the largest British home building companies. It is listed on the London Stock Exchange and is part of the FTSE 100. The company was created from the merger of rivals Taylor Woodrow and George Wimpey in 2007. Let's get started with the model. This company is worth 4.4 billion pounds. And let's see what they're trading at. 121.90, so that's one share of stock. And the way you value a company is you forecast the future free cash flows and then discount that number back to today's value. That's exactly what we're doing in this video. Now we're going to pull their actual free cash flows. And this is cash flow from operations minus capital expenditures. We also need the net income, which is a profit and loss on the income statement. And also the revenue, which are the sales. Let's look at the numbers. Everything looks pretty consistent and steady from year to year. So we should get a good value for this company. Let's look at a capital structure. They pay 9.2 million of interest on their debt. Let's see how much debt they have. We'll go to the balance sheet. Go to the liability section. 85 million of long-term debt. They don't have any current debt. They pay 11% interest on their debt, which is a really high interest rate. Interest payments are tax deductible, so let's get their effective tax rate. 835 million of income before taxes, 162 million of taxes. The effective tax rate is 19%, so the cost of debt is 8.76%. We need the beta now to get the cost of equity. That's how volatile the stock is relative to the market. They have a beta of 1.36, so the stock is a little more volatile than the market. Let's go back to the balance sheet, get their current assets. We need this to calculate the current ratio later. And current assets is 5 billion. And that's 630 million of cash, 120 million in net receivables, and 4.2 billion of inventory. That makes sense. This company would have a lot of inventory. Let's look at the current liabilities. That's 1.1 billion. And that's 798 million of accounts payable. That's how much this company owes other companies. 3.3 billion of stockholders' equity. That's the value of the company according to the balance sheet. 288 million of common stock. 2.2 billion of retained earnings. Retained earnings is your net income that's left over after paying out dividends. Let's see their operating income. 842 million. Let's look at a capital structure. 2% debt, cost of debt is 8.8%, 98% equity, cost of equity is 12.8%, and the WACC is 12.7%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's 6.7 billion pounds. We discounted those numbers back to today using the weighted average cost of capital, that's here in green. We get a value of the company of 6.3 billion pounds. We divide that by 36 million shares, and we get a stock price of 174. It's trading at 122, so it's trading at a 30% discount. So it's a buy according to the model. I didn't see this on Simply Wall Street, this stock. Let's look at the historical stock price. So the stock was trading almost at zero for a few years. I'm not exactly sure why. Maybe someone can leave a comment. It peaked before coronavirus at about 210 it looks, but it dropped quite a bit as you would expect a home builder stock to do. It's come up a little bit but then dropped again. So it could be a risky stock to invest in at this point. Let's look at the ratios. Great PE, great price to sales, great price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 6.5. So investors are paying $6.50 for $1 of earnings. Price to sales is stock price over sales per share. To calculate sales per share, that's Revenue over shares outstanding. I like to see below 2.5, they're at 1.0, so investors are paying $1 for $1 of sales. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 2.5, they're at 1.3, so investors are paying $1.30 for $1 book value. All really good ratios. Current ratio, ROE, and interest coverage ratio are good as well. All the ratios are good. Current ratio is current assets over current liabilities. They definitely can cover their current liabilities. They have a lot of inventory, so it's generally not good to sit on so much inventory, but they are a home builder, so maybe they need it. ROE is net income over equity. I like to see above 20%. They're at 20%, so that's good. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. They don't have much in interest payments. They are mostly all equity. I haven't done a video with somebody in the same industry as Taylor Wimpey, so I can't compare them to anyone. So let me know what you think of the video. Leave a comment. I'll be sure to answer. Thanks for watching.